Hey everyone, welcome back to Corporate Decoder bioAffinity Technologies Inc. BIAF just filed its quarterly report and there is a major red flag I want to show you right now concerning their ability to stay in business. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is trying to make a name for itself in lung cancer diagnostics and even skin cancer treatments. They have a product called Sipit Lung, which is a non-invasive test for early lung cancer detection. They are also working on diagnostics for asthma and COPD and even therapies for skin cancer. Sounds promising, but let's look at the numbers to see how they are really doing. Alright, let's dive into the financial tables. This is where the real story often hides. Looking at their balance sheet as of the 30th of June 2026, we see their cash and cash equivalents have dropped quite a bit. They had over $6 million at the end of 2025, but by June 2026, that number is down to about $2.4 million. That is a significant decrease. Now let's check out their income statement. For the 3 months ending the 30th of June 2026, they reported a net loss of about $3.4 million. And for the 6-month period, the loss is even bigger, coming in at almost $7 million. This is a lot of money bleeding out, especially when you compare it to the same period last year. The net loss for the 6 months ended the 30th of June 2025 was about $6.7 million. So while the loss is slightly bigger this year, the trend is clear, they are consistently losing money. Now here is something really interesting. Look at the weighted average common shares outstanding for the 3 months ended the 30th of June 2026. It was over 5.2 million shares. Compare that to just 800,000 shares in the same period in 2025. This massive increase in shares means they have been issuing a lot of new stock, which dilutes the ownership of existing shareholders. When we look at cash flows, the story gets even more concerning. For the 6 months ended the 30th of June 2026, they used nearly $6.4 million in operating activities. That's a big jump from the almost $4.3 million used in the same period in 2025. This tells us their core business operations are consuming more cash than before, and this leads us directly to the big red flag. They have an accumulated deficit of a whopping $75.6 million. Their cash on hand at the end of June 2026 was only $2.4 million, and they state that this amount will only support their operations through August 2026. This is a classic going concern warning. They explicitly say there is substantial doubt about their ability to continue as a going concern for at least another year. This means they urgently need to find more money, likely through selling more stock or taking on debt, or their business could be in serious trouble. Looking at their equity statement, we can see evidence of this struggle. For the 6 months ended the 30th of June 2026, they sold over 2 million shares of common stock, bringing in about $3.2 million. They also had a public offering in June 2026, raising about $3.2 million in gross proceeds. This is how they are trying to keep the lights on, but it comes at the cost of diluting existing shareholders. They are also burning cash on stock-based compensation. For the 6 months ended the 30th of June 2026, they recognized almost $800,000 in stock-based compensation expense, a significant increase from about $538,000 in the same period last year. This is essentially paying employees and others with stock instead of cash, which is common for startups, but still represents a cost to the company and its existing shareholders. Now, let's talk about a major risk factor they've disclosed. They have received a notice of delisting from Nasdaq. The bid price of their stock has been below $1 for 30 consecutive business days. This is a serious warning sign. If they cannot regain compliance, their stock could be delisted from the Nasdaq capital market. This would make it much harder for investors to buy or sell their shares, potentially leading to a significant drop in value. Think about what happened to Bed Bath and Beyond or Rite Aid when they faced similar issues. Historically, about half of companies that do reverse stock splits to try and fix this end up delisted anyway. On the revenue side, things are a bit mixed. For the 6 month ended the 30th of June 2026, their total net revenue was about $2.9 million, a decrease from $3.1 million in the same period last year. They attribute this to discontinuing some unprofitable pathology services. However, their flagship product, Sipit Lung, did see revenue growth. Sipit Lung testing revenue increased to $835,000 for the first 6 months of 2026, up from $323,000 in 2025. This is positive, but it is not enough to offset the overall revenue decrease and their massive operating losses. Their selling, general, and administrative expenses are a big concern. For the 6 months ended the 30th of June 2026, these costs were over $6.1 million, a significant jump from about $4.7 million in the same period last year. This increase is driven by higher employee compensation, sales, and marketing costs. and general administrative expenses as they try to grow. The net loss before taxes for the 6 months ended the 30th of June 2026 was almost $7 million. This shows how much more money they are spending than they are bringing in. A big part of the reduced expenses this year compared to last year comes from things like change in fair value of warrants issued. In 2025, they had a loss of over $1 million related to this, and that is not present in 2026. This is a bit of accounting magic that makes the current year look better by comparison, but it doesn't change the fundamental cash burn. So, what is my take on bioAffinity technologies? They are in a tough spot. While their core product Lung shows promise and is growing, the company is burning through cash at an alarming rate. They are heavily reliant on raising new capital, and the threat of delisting from Nasdaq is a major red flag. The fact that their cash reserves are projected to only last them through August of this year is a critical indicator of their immediate financial vulnerability. They need to show a clear path to profitability, and quickly. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. Alright, that is my take on bioAffinity Technologies' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.